Okay, so picture this. The entire U.S. firearm industry is barely growing. Like, national background checks barely have a pulse right now. And yet, somehow, Smith & Wesson just posted a quarter where their unit shipments shot up over 23%. Pun totally intended. Welcome to Earnings Unscripted, folks. It is June 17th, 2026, and we are unpacking Smith & Wesson's fiscal Q4, ticker SWBI. And Miro, EPS surged to 36 cents from just 8 cents last quarter. Net sales jumped over 31% to 178.4 million. What kind of anomaly is this?
It is market share theft in broad daylight. That is the short answer. Because you look at the NICS background check data, which is the industry proxy, and that was up maybe 1.1%. So Smith & Wesson did not ride a macro wave here. They aggressively ate their competitors' lunch.
They really did. And Wall Street threw a total party for it. The stock kind of yawned during regular hours, finishing slightly down, but immediately after the bell, it just spiked, gapped up over 17% into the $16 range in extended trading, which actually, real quick before we get too deep, obligatory reminder that this podcast is just our personal opinions and not financial advice, so please do not go chasing after hours gaps on our account. But Miro, going back to the numbers, how exactly do you pull off a 23% volume jump in a totally flat market?
Pricing power and product velocity. Usually you associate legacy manufacturing with, slow, cautious iteration, but they just booked over 37% of their total Q4 revenue purely from newly introduced products.
Wow, almost 40%. That feels more like a consumer tech cycle than a hardware utility brand.
Exactly. It behaves perfectly like a sneaker drop or a phone upgrade cycle. They figured out how to force demand on hardware that technically lasts forever. You release a highly anticipated new model, and suddenly the diehard base feels they have to upgrade. Plus, they executed a really smooth price hike in January. Average selling prices actually ticked up around 4% sequentially for both handguns and long guns.
Right. And in this economy, I read management said that hike went through with literally zero fanfare from distributors. Nobody pushed back.
Yeah, nobody blinked. Because if the end consumer is knocking down the door for the specific new model, the retailer just has to swallow the wholesale bump. And when you combine that inelastic price with much higher production volume, your fixed cost absorption improves massively. Their operating income did not just it actually exploded from 6.7 million in Q3 to 21.3 million.
Jeez, that is roughly a 217% jump. Am I doing that right?
Yeah, you were spot on. Gross margins expanded 360 basis points sequentially to nearly 30%. It is a textbook operational snapback. They stopped bleeding down old internal inventory and flipped the switch to build for fresh demand.
Okay, that paints a really clear picture. It's less about a booming industry and more about just pure, ruthless execution. All right, let's actually get into the details on where all this extra cash is going, because the balance sheet cleanup they did here is fascinating.
Yes, they basically nuked their short-term debt. Look, the free cash flow for the fourth quarter alone was right at $69.7 million. For context, in the first 9 months of the year combined, they only generated $16 million. So this was a massive sudden liquidity sprint.
Okay, that is a huge leap. I am assuming they did not just park all of that in a savings account.
Not at all. They used that cash geyser to wipe $55 million right off their revolving credit line. Their total short-term notes and loans dropped by over 74% compared to the third quarter. They ended the fiscal year with under $20 million on the books, essentially debt-free.
That is an incredibly clean balance sheet, which usually begs the question, what happens next? If you have no debt and you are suddenly throwing off that much cash, what is the capital allocation play?
Well, this is where I found something. Actually, something pretty surprising in the transcript. They are guiding for a major capital expenditure spike next year. They plan to spend roughly $20 million above their normal baseline strictly to add about 20 new heavy-duty CNC milling machines.
Wait, back up. Did they not just spend years executing this highly publicized relocation down to Maryville, Tennessee? I thought the whole corporate narrative was fleeing the political environment in Massachusetts. Why are they suddenly buying massive factory equipment for the old hub?
Exactly. That was the assumed narrative, and Wall Street kind of bought it wholesale. But the CEO, Mark Smith, He explicitly cleared that up on the call. Maryville is the new headquarters. It handles final assembly, finishing, distribution, but the legacy Springfield Mass factory, that is cementing itself as the permanent machining hub.
So they are essentially splitting the company in half, leaving the brains in the south and the brawn up north.
Right. Well, it's more like blue-collar precision versus final assembly. Because I actually pulled his quote. Give me a second here. Okay, he said, quote, "The investment in capacity is happening in Springfield because that is the machining center." And then he added, "The machining is going to be planned to be forever," end quote.
Forever. You really do not hear public company executives commit to forever on earnings calls. Usually it's a vague 3 to 5 year strategic window.
No, you do not, but it reveals a hidden truth about industrial manufacturing. You can relocate your executive suites and your shipping warehouses to a tax-friendly state fairly easily, but you cannot easily pack up generations of deeply specialized CNC machining talent. They literally need those Massachusetts operators to cut the metal.
That is such a great human point. Your specialized talent is the absolute ceiling on your growth. It does not matter what your corporate tax rate is if you do not have the master machinists who actually know how to program a mill to extreme tolerances. So it is just pure, unvarnished pragmatism.
Completely. Skill density dictates geography, and this is also a play to protect long-term margins by pulling some previously outsourced machining back in-house.
So what exactly are they planning to cut with 20 new CNC machines? I mean, is it just churning out endless volumes of the exact same micro-compact pistols?
No, actually. I was going to say that leads to the second piece of the strategy that caught my eye. They are aggressively pushing into white space that they historically kind of ignored, the hunting segment.
Really? Because I always associate Smith & Wesson with tactical setups, personal defense, maybe law enforcement, not exactly traditional deer hunting rifles.
Sure, but if your legacy handgun market is highly saturated, you have to hunt for new total addressable markets somewhere else. So they recently rolled out this Model 1854 lever-action rifle and a unique folding pistol carbine. It is management realizing they need to cross over into classic Americana hunting if they want to keep those overall unit volumes climbing.
That is smart, though. It diversifies them away from just riding the politically volatile tactical sales cycles. They are recognizing they cannot just ride one specific product profile forever.
Yes, and those new traditional long guns require a lot of heavy, high-precision metalwork, which brings us right back full circle to why they're dumping $20 million into the Springfield factory. It all connects. But look, this kind of aggressive expansion does come at a price. When you look at what they're forecasting for the next immediate quarter, it gets a little bumpy.
Right, because a quarter this flawless usually hides a bit of a hangover somewhere. So what's the catch they warned us about?
The catch is the cost of keeping the momentum going. Management is actually guiding for a 20% spike in Q1 operating expenses, which is a huge jump.
Wait, 20%? After they just cleaned up the balance sheet?
Yeah, the CFO, Deanna McPherson, was really specific about it. She pointed out that it is tied directly to volume and profit-related costs, like freight, profit sharing, and crucially, customer marketing allowances.
Okay, I see. So that is the hidden tax of eating everyone else's lunch. If you want to hold on to that 23% volume gain, you basically have to pay to defend the territory.
Exactly. You are buying loyalty at that point. And the math gets a little tighter because they also warned of a sequential drop in average selling prices next quarter, about 5%.
Oh, because of the mix shift?
Yes, just because they're leaning slightly more heavily into lower-priced long guns to capture that new hunting demographic we just talked about.
It is always a trade-off. You break into a fresh demographic, but it temporarily dilutes your premium pricing. Plus, I noticed they slipped in a very quiet warning about tariffs. Management admitted that increased volume-related tariffs actually dulled some of their gross margin gains.
That is the big unknown here. They can optimize their factories all day long, but if global trade dynamics shift next year, raw materials simply get more expensive. You cannot CNC machine your way out of a tariff.
So true. It feels like they're operating flawlessly, but they're doing it at an altitude where any incoming breeze is going to be felt immediately.
That is exactly it. The machine is running perfectly, but the external environment is only going to get noisier from here.
Well, we love some good market noise. I think that's a wrap for Smith & Wesson's Big Quarter. Thanks for tuning in, everyone. Talk to you next time.
Goodbye.
And hey, if you want these earnings drops to just magically show up in your feed, just follow the show. Also, a quick reminder that our voices and the script are actually AI generated, which is still pretty wild to think about, but it lets us cover so much more ground. If there's a specific ticker you want us to dig into, just drop us an email at earningsunscripted@datamadness.ca or hit the X link in the show notes.
See you out there.